I'm Deborah Borchardt, and this is your midday market update. Well, right now we got lots of selling going on, but not as bad as what we saw this morning. It does look like our losses are being trimmed back as we go into the midday. Joining me now is Mark Newton. He's the chief market technician over at Greywolf. So Mark, you know, a lot of people have been saying, well, we're going to get this big correction, although I don't think that they thought the correction would come in this form. So the question starts to become, you know, is this the time to buy because now we started to see some of this pullback, or is it better to kind of wait until we get this government stuff resolved?
Well, I think if you have a long-term perspective, it's always better to wait until you have a little bit more clarity. I mean, the sell-off hasn't really been all that extreme. We're really at the same levels we were last Monday. If you look at the S&P at 1681, we're within a couple ticks of that. So this pullback has been very similar to what we saw in August and also in late May, early June. Market corrected 3 to 4%, but we really didn't do too much technical damage. It's interesting, though, that although the Russell and the NASDAQ hit new highs, particularly in relative terms, you know, the Dow and the S&P are still under levels that were hit back in early May. So the market really hasn't gone anywhere in 4.5 months, even though the market's up 18%. It's really been sort of a grind. A lot of people have had a tough time making money. You know, there's been a lot of rotation in and out of certain names, in and out of sectors. Discretionary continues to do well, the industrials, and they've recently started to pull back a bit. Financials has been the area that's, I think, of greatest concern because they're the market leader, represent 18% of the S&P, and yet financials peaked out in July in relative terms, and you know, it's been tough to rally without having the financials as part of that strength.
A lot of focus is on the bond market. What are we seeing there?
Bond market's been range bound for the last 10 days or so, really no real movement. I still expect that yields can pull back to around 2.5, 2.45% in the 10-year before you see any sort of up move. The Chinese had an interesting article come out that sort of warned the U.S. about becoming too complacent about this debt ceiling. If no steps are taken, you know, it's worth reminding people that they do own a large amount of treasuries, and they could easily just say, okay, we're going to start to sell. That would cause huge upward pressure on the rates. Right now, you know, I don't see that. It still looks like rates are going to come back a bit.
But we've been in this situation before, and what we've seen before is the Treasury kind of prioritizes their payments, and they make the interest payments, and they make the Social Security payments, and then the only people that they kind of, you know, jerk around to the contract workers and the government workers, and they give them IOUs.
That's definitely a glass half full sense of optimism, and a lot of people share that same thing. Like, you know, what's to worry about? There's nothing, you know, everything's going to be resolved. There's no reason for concern. Any sort of default would be a pretty major deal. I do think the government eventually will get its act together and come down and come together, and we'll figure things out. We need to figure out a way to continue to cut spending. The Republicans have already let a certain amount go with regards to 2014 targets, which have been raised for the total amount of spending caps. Because of the sequester, we put a certain amount under key, and we can't afford to really let those continue to be raised. One interesting market to look at is Japan, which I've mentioned, which has really lost about 1,000 points in the Nikkei in the last 7 trading days. And so that's really what's interesting, is investors are increasingly, I think, disgruntled with Abe and Abenomics. It's really starting to see real pressure on that market, and of course on dollar yen, which has broken down. So in the past, you've seen a little bit of correlation with the markets here with dollar yen movements, and recently we've sort of cracked on dollar yen. So it'll be interesting to see how we respond to that.
All right, well, we'll start to keep that on our radar and keep that Japanese market on our radar. But as Mark and I were saying, you know, right now the market is down, but not severely so. And that's Mark Newton, and I'm Deborah Borchardt with The Street.